Welcome back, VITA volunteers. At this point, you have successfully made it through our lessons on starting a return, choosing a filing status, and determining who can be claimed on a return as a dependent. In this lesson, we will begin discussing common sources of income, both earned and unearned. It's at this point in the return preparation process that you will really feel that the return is moving forward. It is important that we begin conceptually with this idea that all worldwide income is taxable to U.S. citizens. And that is true, generally speaking. But there are some caveats. There are specific exceptions written into the tax law. Note that if a source of income is not specifically excluded, it will be taxable. Note also that excluded income is not the same as a deduction from income. This is an important difference because excluded income is not used in the calculation of a filing requirement, and it's also excluded when calculating adjusted gross income. Remember, adjusted gross income is that special line on the return that affects some of the other tax benefits that our taxpayer can claim. Some commonly excluded sources of income include child support, alimony if the decree of divorce is after December 31st, 2018. Gifts are excluded to the recipient. Inheritance is also excluded income for the recipient. Welfare payments, so any payments that are based on need, are excluded, as well as supplemental Social Security benefits, or SSI. In addition, another source of income that might be all or partially excluded is Social Security benefits, and that's going to be based on the other income that our taxpayer has. And we will cover more about how Social Security is taxed or not taxed and the calculation of that in a future lesson. Now, the list that I just gave you is not exhaustive, but I think those are the sources of income that are excluded that we'll most likely will see through our program. But we do also have our Publication 4012 in tab D. There's a quick reference guide that gives some other examples of taxable and non-taxable income. As well, there is an interactive tax assistant. You can see that there's a section there for retirement, pensions, IRAs, and Social Security. Some of those will help you know if those items are going to be taxable. And then under other income, there are some more tax assistance that will help you determine if that particular type of income will be taxable. So we are going to begin our discussion of taxable income with earned income, and more specifically wages, which is probably the most common source of income we are going to see. And those will be reported on Form W-2. And many of you may have seen your own W-2, but for those of you who might be new to looking at all of the little boxes and what they mean, we're going to take a little tour. Now, it's important to understand at the beginning of this that when we enter information into the return, or our taxpayers are entering their information into the return and we're guiding them, that all of the information from the W-2 is reported exactly as it was reported on the W-2. And this includes box A with the taxpayer's Social Security number and box B with the employer's EIN, or employer identification number. And this is really important because the documents are cross-referenced through the IRS document matching program. So the employer has already reported to the IRS what they have reported to the taxpayer, and the IRS is going to match those documents through software And if there's a mismatch, then our taxpayer is going to get a letter from the IRS wondering why there is a mismatch. So always, always, always report things exactly as they are on the W-2. And this is important even when you might have a taxpayer with an ITIN that is different than the Social Security number that's reported on the W-2. In that situation, the taxpayer files the return under their ITIN, which you've seen their documentation, the proof of that tax identification number. But when you enter that W-2, again, the Social Security number on the W-2 is what you will enter on the return. Moving on, box 1 is where the employer will report wages, tips, and other compensation. And then box 2 is where the employer reports the federal income tax that was withheld throughout the year. And here is how that information flows onto the return. You can see there up on the right-hand corner, we have from our W-2 boxes 1 and 2. And box 1 ends up on line 1 of the 1040, wages, tips, and etc. Box 2 ends up on page 2, line 25, and that's where you enter in federal income tax withheld from Forms W-2 on 25A. Boxes 3 through 7 on the Form W-2 are where the employer reports Social Security and Medicare tax information. Now, TaxSlayer, when you enter box 1 into the software, will automatically calculate these boxes. But it's always important to double check with the form. As we talked about earlier, always enter what is on the form. So you might need to change the entry from what the automatic calculation was. Now, boxes 3 and 5 are Social Security wages and Medicare wages and tips, respectively. And those amounts might be different than what is reported in box 1, and that's okay, particularly if you are seeing numbers in box 12. That is because the base, or the amount of income, and what's taxable income for those taxes for Social Security and Medicare is different than what is taxable income for income tax. Box 8 is for allocated tips, and certain employers, mainly like large national restaurant chains, are required to use this box to estimate the cash tips of a server under certain circumstances. And if we have somebody who states that they are a server or another industry where cash tips are common, we are always going to double check with them to make sure that their Form W-2 is reporting all of their tips, or if they had some other cash tips that aren't reported there, because all tips, whether they're reported on the Form W-2 or whether they were just received in cash, are taxable. Now, it's important to note that unreported tips require advanced certification. So if this taxpayer states that they have other tips that they need to report, we need to find a preparer and a quality reviewer with advanced certification. If that's not available on site, then we would need to refer that taxpayer to a different location or a paid preparer. Boxes 10 through 14 have some other types of information. Box 10 is dependent care benefits, and that will be important particularly if our taxpayer is wanting to claim the child and dependent care credit. Any amount in box 10 will affect how much they are able to claim for that credit. Box 11 we probably aren't going to see a lot of in our program. It's generally used for highly paid executives for their retirement plans. Box 12, you'll notice that it has a 12A, B, C, D, and there's a little line that runs through the middle of it. On the left, there will be a letter code, and then an amount will be on the right. we'll talk a little bit more about some of the common codes that we're going to see in the next slide. Box 13 has some checkboxes, and you won't want to miss these. They do help with understanding what is reported in Box 1, as well as whether our client can claim certain things like IRA deductions. So again, you'll want to make sure to catch those little checkboxes. They can sometimes be easy to miss. Box 14 is just kind of a blanket, any other information that the employer wishes to provide. It could be things like moving expenses that were paid as a fringe benefit. For Washington and Oregon returns, you might see amounts for state paid family leave and medical leave taxes. There is also an Oregon transit tax that gets put in there. This just gives you an idea that there's a wide variety of things that you might see in that box. In the TaxSlayer software, there's a drop-down with a selection with many selections, one of which is just Other, which is most often what you'll end up using to report whatever's in box 14. As promised, here again is box 12, some of the more common codes. You'll see D, that's for 401k contributions, and usually with that, you'll see in box 13, the retirement plan checkbox should be checked. But again, if it's not, enter it as it is on the form W-2. Code E is a similar situation. It's 403B, another type of retirement plan, qualified retirement plan. Code DD is employer-sponsored health coverage. Code W is for flexible spending accounts or health savings accounts contributions. Those two will require advanced certification. And then in 4012 in tab D, there's another reference guide for other common box 12 codes. Additionally, a lot of times there'll be a second page with the W-2, or it'll be printed on the back of the W-2, a list of the codes. There are more codes than just these, but these are the ones you'll probably most often see. Box D is for control number, and this is one of just a couple of exceptions where you do not need to enter it into the return preparation software. It is a number generated by a company's payroll system, and it is used when taxpayers import W-2 information digitally directly from their employer. Our process uses you to enter the information into the return, so you do not need to enter this number into the software. Boxes 15 through 20 are state and local tax information. Washington does not have a state income tax, so if the W-2 has state tax reported for Washington, you should not enter it into the return. If you do, it can lead to diagnostics that tie up the return because the software will think you should be filing a state return. Oregon, however, does have a state income tax, and we will see quite a few of these. As the season approaches, we will have a lesson covering how to do Oregon taxes, but for now, just note that Oregon taxes its residents on all income with few exceptions. Oregon also taxes non-residents on income that can be attributed to Oregon. Commonly, this is Washington residents who spend days working in Oregon. I like to show you that there are also other formats that the IRS accepts for the W-2. This was something that when I very first started doing taxes, got into the field, and all of a sudden the W-2s did not look at all like the ones that I had been practicing with. So these are some examples of other layouts that you might see for Form W-2, and particularly the one on the right. It's enough different, and the print is often very tiny. You need a magnifying glass to see it. I just don't want you to feel thrown off if you see that. I think that was the one that I saw on my very first return that I did professionally, and I was a little nervous, and boy, that small print was just getting even smaller. So if you get a W-2 like this, first off, don't panic. Just take a deep breath. Usually box 1 and 2 have a little extra dark lines around them, outline around them, so you can try to find box 1 and 2 first, and then kind of orient yourself around the other boxes. Yeah, you don't need to panic. It's okay. You'll figure it out. Just take a deep breath and start trying to orient yourself. And sometimes we might have a client come in and tell us that they are missing their W-2. Maybe their employer didn't send it or they didn't receive it. So we do have some workarounds. Employers are required to send it by January 31st, but sometimes the mail can take up to a couple weeks longer. So, people might not be seeing it until mid-February. So if you've got somebody coming in early February and they report that they haven't received their W-2 yet, let them know, maybe wait a couple weeks. If it's been a couple weeks, it's mid-February, the client might need to contact their employer. Sometimes if they've had an address change, they just need to let the employer know that they've had the address change. Sometimes employers are giving it access to the W-2 digitally and people have forgotten how to log in. This is information that their employer should be able to help them navigate. If they can't get their W-2, it is possible to use the year-end pay stub, and there's a checkbox in TaxSlayer for a substitute W-2. If they're using their year-end pay stub, then you would check that box and it will generate Form 4852, which is a substitute for the W-2. If it's the end of February and the client hasn't gotten a W-2, and certainly not all clients keep their year-end pay stubs, we can encourage our clients to go ahead and just call the IRS and let the IRS know if the employer is not responding. The IRS kind of will contact the employer and lean in a little bit. A couple of other circumstances with regard to the W-2. We do have taxable scholarships, some of which will be reported on a W-2. However, not all taxable scholarships are reported on a W-2. Some are reported on Form 1098-T. When the taxable scholarship is not reported on Form W-2, it will be entered into the software as other compensation, which will cause the income to flow onto the 1040 in line 8 from Schedule 1 for additional income and adjustments to income. But if it is reported on Form W-2, the entries will be made in the W-2 entry screens. We also have household employees who are generally entitled to get a W-2 as well, but they may not if their earnings were less than that amount that you see there on the slide. Line 1B of the 1040 is a dedicated line for household employee wages not reported on Form W-2. And this would also be entered in the other compensation part of the software. So moving on, we're going to start talking about unearned income. And the difference between earned income and unearned income is important. It does affect certain credits, especially the earned income tax credit. So the sources of income that we're going to be talking about moving forward would not count towards the earned income tax credit and some other credits. So we're going to begin with interest, and interest might be taxable even if it's not reported on this form as 1099 INT or for interest income. Sometimes people have informal arrangements where they lend money and get interest. That interest is taxable regardless of whether it's reported to our client on this form or not. So we need to be really clear about that with them and just make sure that there aren't any possible extra interest sources that need to be reported. It's important to note that in TaxSlayer, the only entry that is required is for the payer name. So if it is a situation where somebody's getting interest income that hasn't been reported on the 1099 interest statement, they wouldn't have the EIN. That doesn't need to be entered. It's not required to be entered. They just need to report the payer name. And then you'll notice, and I know it's a little bit small and I didn't put a box around it, but box 8 is for tax exempt interest. So if there is a entry in that box, you just want to be sure that even though it is exempt from income tax, we do report it on the tax return, and that's because it affects things like the taxable amount of Social Security, which, if you'll remember, Social Security may be exempt from income tax, or some parts of it may be, and tax exempt interest goes into that calculation. So looking at how interest flows onto the Form 1040, you'll see on page 1, we have box 2A is where the tax-exempt interest shows up, and box 2B is where the taxable interest shows up. So you can see that they both show up on that front of that return, but they are separated out. And then also, if there's more than $1,500 total of interest income, Schedule B will be attached to the return. In TaxSlayer, the entry is in the same spot, and the software will generate Form Schedule B if it's required. Our next source of unearned income are dividends. And for those of you who maybe have not taken an accounting course, or just as a reminder to anybody who has taken an accounting course, dividend is when our taxpayer owns a share of a company, and that company pays out some of their earnings to the shareholders. So our taxpayer gets a little bit of this income, and it's going to be reported to them, and then they are going to put that on their return as an unearned source of income. And ordinary dividends show up on Form 1099 Div in box 1A, and these are taxed at the ordinary income tax rate, unless under special circumstances they might be considered qualified dividends, and those can be taxed at a different rate, the long-term capital gains rate, which is usually less than somebody's ordinary tax rate. So you'll find the amount of qualified dividends in box 1B. It's really common to see the same amount reported in 1A and 1B, and this generally means that all of the ordinary dividends were in fact qualified dividends, and that usually has to do with how long our taxpayer has owned the shares that these dividends are coming from. Then in box 2 A, we have our total capital gains distributions, and these generally come because our taxpayer owned a mutual fund or a real estate investment trust, and these will flow to Schedule D. Schedule D is generally something that we're not going to see a lot of because it requires advanced certification when somebody is selling the shares of income. But there are a few little circumstances like this where there might be an amount reported in on that 1099 div, and that will generate Schedule D for us. So again, looking at how this flows onto Form 1040, we're now in line 3. Line 3A is where those qualified dividends go. Remember, we're pulling those out because they qualify for a different tax rate. And then in line 3B is ordinary dividends. Again, just like with the interest, if there is more than $1,500 total, it's going to be required for Schedule B to be attached. Ordinary dividends are in Part 2. Interest was in Part 1 of Schedule B, and Part 2 is for ordinary dividends. And then again, that box 2A, the total capital gains distribution, remember it's going to go on Schedule D for our capital gains and losses. And that ends up flowing to line 13 of Schedule D, which in turn flows up into the 1040 on line 7 for capital gains or losses. Just a couple more boxes on the 1099 div. We have in box 3 non-dividend distributions, and there is a space to report this on the dividend screen in TaxSlayer, but it's also important to note that these are considered a return of the taxpayer's investment, and they reduce the taxpayer's cost in that underlying asset, which is probably a stock. And they need to keep record of this because eventually down the road when they sell that stock, they're going to need to report what their cost was so they can figure out what their gain was. And then we have box 6, which is section 199A dividends. And these are the one instance where as basic certified tax preparers, we're going to see qualified business income deduction. Usually this shows up when somebody has a sole proprietorship, but this particular box, if there's an amount in it, it will generate a little bit of qualified business income deduction for them, and that's line 13 of the 1040. Now we'll move on to a couple of special income topics, and the first of these is the state and local refund. So we might see this if, say, in a previous year before the tax year that we're looking at, our taxpayer either lived in Oregon or maybe they worked in Oregon and they aren't for the current tax year. But they might receive a state income tax refund. And they might have taken this, their state taxes off of their taxable income as a deduction if they itemized. So if they itemized, then some of this refund might need to be included in our taxable income for the current year. And there is a worksheet that helps figure out if some or all of it is taxable. And that there is a button to push in TaxSlayer where you can get to this worksheet. If the taxpayer just took the standard deduction in that prior year, then the refund will not be included in taxable income for the current year. And this is probably going to be the case for most of our taxpayers. Our second special income topic is alimony. And as we talked about in the excluded from income slide, if the divorce decree is after December 31st, 2018, then that alimony is not taxable to the recipient. If the decree is before that, then it generally will be taxable to the recipient. And on the other side of that, the person paying the alimony would be able to deduct that from their income. But if the decree is after that December 31st, 2018, the recipient does not claim it as income and the payer does not deduct it as income. And there's a little more information in a chart in publication 4012 on tab E.